Good morning once again. How about now?
Yes, we
Yes, we
hear
can.
you.
Oh, you can hear me now. Wonderful, wonderful. Yeah, thank you. Thank you. Okay, apologies for a technical delay. We are set to start now. Sorry once again for the mishap. Okay, so we're finally in. You can see the whiteboard, all right?
Yes.
Okay, so what we are going to discuss today, last time, you remember where we stopped? So we discussed the beginnings of exchange-based financial trading. We said, okay, there is a Moscow exchange. There are instruments like USD, ruble, euro ruble, and so on traded at the Moscow exchange. And there is a notion of a matching engine, orders sent to that matching engine, and trades. We discussed in detail the relationship, by the way, between the interest rates and the exchange rates. So we realized that actually it is completely normal to expect that due to the difference in exchange rates, sorry, in interest rates, that the USD ruble exchange rate tomorrow will be higher than that of today on average. There is nothing sinister about this, it is just due to exchange rates. So today is a very important point. We are discussing the microstructure of matching engines and of financial markets. It's something which you have already seen in your practical sessions and started working on it. Yet it is important to reiterate the point, and we are discussing this once again. These details are important and will be, I think, we'll meet them once again and every time we're working with order books and orders. So basically, there is such a thing as the order book, and this order book is a central piece of the exchange. There are some other techniques which can be used in a financial exchange apart from the order book, but order book is by far the most important of them. So let's see how it works. Just a second. Something has changed. Um, yes. Okay. So the order book consists of two parts, as we know. There is this part which is called asks and the part which is called bids. The asks part contain the orders to sell the instrument. So if our instrument, for the sake of the argument, is, if you remember, USD ruble, and we can denote it by USD 000 UTS tomorrow, you remember what it is? It is USD ruble with the delivery tomorrow. So it means that we are trading 1 unit, for example, of USD per rubles, the price of this instrument is the price. What is the price of, this is our instrument I. What is the price of I? The price of I is the price of 1 USD in rubles. So the number of rubles, which is the number of rubles, such that the value of this number of rubles equivalent in value to 1 USD. This is 1 USD. So that's the price. So effectively, when we say we are buying or selling USD ruble, it means simply we are buying or selling 1 USD, in fact more than one, we specify the quantity, we are selling USD for ruble. So asks are orders to sell I, our instrument I, means to sell USD, effectively. And bids are orders to buy USD. Asks are also called sometimes offers. Bids are bids, asks are sometimes also called offers. Why offers? Because those who posted those orders, they offer USD to sell. So what it means? It means that there are market participants who are going to buy or sell currency. And first of all, you can't say arbitrary quantities. You can't sell, for example, 1 USD or 1.5. There is a minimum lot of 1,000 in this case. Any quantity is a multiple of this minimum lot of 1,000. And at each moment, when the order book is stationary, what it means stationary, what it means by stationary, we'll see. At any moment, there are orders, quantities, and numbers corresponding to those buy and sell sides. So these are two sides of the order book. So suppose that there are several orders. People want to buy USD. Someone wants to buy 1,000. You know what? In order to keep our writing short, I will write 1 instead of 1,000 and so on. So you will not need to see an excessive number of zeros. Someone would like to buy 1,000. Another market participant would like to buy 2,000. And yet another would like to buy, for example, 4,000. And all of them are prepared to pay no more than 74.99 per USD. They want to buy 1,000, 2,000, 4,000, but they specify a so-called limit price. Limit price. Yes, we want to buy but at the price no more than 74.99. There are some other market participants who want to buy, for example, even more. One would like to buy 10, yet another maybe 5, yet another 3, but they are not even prepared to pay 74.99. They are only prepared to pay 74.98, and so on. So there are many orders, but the maximum price at which those market participants agree to buy USD is limited by 74.99. So price increases from maybe there are even such people, and why not, who would like to buy USD for 10 rubles somewhere here in the bottom of the order book, but the exchange will not even allow them to place such an order, and that's important. So the difference between the top bid price, and any other price allowed in the order book is it depends on the policy, and we may double check it, but I believe that it is only 1%. So you are not allowed to put a very low price here. Why? Because the order, when you want to buy USD for a very low price, is extremely unlikely to fill, and it will just stay in the order book. No one would, if you go to the exchange, for example, and try to buy USD for 10 rubles now, it is extremely unlikely that anyone would sell you USD for 10 rubles. So your order is going to stay in the order book and just without any chance of being filled or executed, and it will just uselessly lock up the technical resources which is required for order management, because this order book is obviously completely computerized. It exists in fact only in the memory of uh, the exchange-based server-side computer, which maintains this order book. So an excessive number of orders extremely unlikely to fill would only complicate, overload, unnecessarily overload the matching engine. And that's why this limit. So yes, you can probably to buy cheaper, but you are only allowed to place your orders within 1% from the best price. Otherwise, your order is simply discarded by the matching engine and not even placed in the order book. Okay.
Sorry, can I ask,
Yeah, please, yes.
what if on the start of the day, uh, like, there is no beats in order book, and can I place the beat on 10 rebels, for example?
Yes. So if it happens that, and it may happen for an extremely liquid asset, sometimes it happens that there are no bids, then you are allowed to place a bid at any price. But once it is placed, then it is considered to occupy the top of the book, so it will be here, and after that, subsequent bids would only be allowed within 1% of that bid. If it comes to a very extreme situation, when, for example, one part of the order book is empty or something very dramatic has happened, then the exchange may relax these rules and allow more orders to be placed. But for liquid markets like USD ruble, in which you do expect a lot of orders, then this rule works. So you would not be able to place a very low bid. On the other hand, on the other hand, there are orders to sell, which are asks, and those orders, I'm talking about an order book which is so-called stationary at the moment. So these orders are placed, but nothing is happening with them. In that case, the orders to ask are always placed above the orders to buy. So sell or offer or ask orders are strictly above the bids buy orders, and there is a gap between them, which is called bid-ask spread. By the way, from the data you have already seen, I'm just putting 74.99, 74.98 for the sake of the argument. You know that from the data you have already seen that the minimum separation between the price levels, this is called price step. PX stands for price. In this case, price step is 0.01 ruble or 1 kopeck. What is the real price step in the Moscow exchange in USD ruble from the data you have seen already?
Half of that,
Yes?
like 0.005.
No, 25. It is 0.0025. So it is 1/4 of a kopeck, or 0.0025 ruble. That's the price step. The bid-ask spread is the price difference between the lowest ask. The price continues to increase upwards. Okay, so it was increasing here in bids. It is increasing here in asks. The price is increasing. So here we have the lowest ask, and suppose that someone is selling 1, 3, and 5,000 USD, and all of them they are selling for the price of 7501. Okay, for the price of 7501. And there is a bid-ask spread, as you can see, of 0.02 rubles or 2 kopecks. In this particular example, this price bid-ask spread is 2 times the price step, but in reality it is a little bit more than that. So it could be 1.5 or 2 kopecks, that's correct, but the price step is smaller. So in terms of price steps, you would typically have, for example, if it is 1.5 kopecks and here we have a quarter, then it is about 6 times, maybe sometimes 8 times price step. So bid-ask spread is n times price step, and this typical value for n for this USD ruble market is typically, let's say, 6.8, something like this. And that's extremely important. This value of n is extremely important, and I will explain why it is so important. There are markets, not this particular one, but there are such markets where price bid-ask spread, typical bid-ask spread, what could be the minimum value of bid-ask spread? Here we say it is 6 or 8 times, for example, price step. What is the minimum value of bid-ask spread? What do you think?
The step,
Yes,
price step.
one step. Of course, you are right. It cannot be zero. It is never zero. It is always positive. It is always positive, and it is always proportional to the price step, and therefore the minimum n equals to 1. That's no doubt. And there are markets, for example, even in the Moscow exchange, it in the market for futures on USD ruble, where n typically equals to 1. In this case, asks and bids are really next to each other. So it would be, for example, 74.99 and 74.9925, something like this. So they would be immediately adjacent to each other. But here we have a larger value, and this value n is extremely important from the point of view of how a certain type of market strategies would work. So you can do something very interesting when n is equal to 6 to 8, and you can't do almost that thing when n equals to 1. What is it? I will explain later. Okay, and then there are other quantities and so on, but they are placed at higher prices. So for example, the next here for the sake of the argument is 75.02 and so on. So for example, again here someone would like to sell 20 but only at the price 75.02, sell 10, another market participant agrees to sell 10 but again at the price 75.02. As you can see, that the order book, two sides, bids and tasks, arranged first by price in the ascending, increasing order of price. Only the best bid, it is called the best bid here. Why the best? Because it is the most likely to fill. It corresponds to the highest bid, and the best ask, again, orders most likely to fill, correspond to the lowest ask, and a positive separation between them, which is a bid-ask spread n times price step, where minimum n is 1, but it could be larger than that. So that is a situation at any time t. If we take a snapshot of the order book, the order book consists of orders arranged according to the price. Multiple orders with different quantities can occupy the corresponding price levels, and that's how it looks like. As you can see, these are only orders at the prices of these orders are so-called limit prices, and these orders are installed in the order book on the bid and task side, and then nothing happens, nothing really happens to those orders. What does it mean nothing happens? These are orders staying in the order book, but they are not filled or not matched. There are no trades here. All right? Okay. You place an order for 74.99. It is placed in the order book. You want to buy at that price, but no one wants to sell you at that price. So you order to buy, staying in the order book, but you are not getting your USD because no one agrees to sell you USD at 74.99. These people would like to sell USD at 75.01, and the orders are again staying indefinitely in the order book, and they are not filled because no one would like to pay 75.01 for the USD. People only prepared to pay 74.99. So some element is missing in this picture. Okay, this is indeed the structure of the order book, but then comes a very important person who is called, you remember the term, maybe you have heard it already in your lab sessions. So who is missing from this picture? For the moment, we only have orders, but we don't have trades. Those people on the bid side insist on the price no higher than 74.99. Those people on the ask side insist on the price no less than 75.01, and nothing happens. So there is a very important kind of market participants who then make this picture dynamic. Without them, nothing would happen and they would just stay in the order book like that. You remember how they are called?
Traders.
Well, all of them are traders. If you place your order and the order is put in the order book, you're already a trader. Those are very special type of traders, and actually any trader, in this case, the traders are passive. They placed limit orders in the order book. The orders are staying there and waiting. So these traders are passive ones. But there are also traders who are simply called aggressors. And these are very important type of traders because for them it is important to buy or sell USD immediately now. They cannot just place an order at 74.99 and then wait and wait and wait, not being sure what will happen with the order. So suppose that for someone it is really important to buy USD now. What would they do? They would not place an order at 74.99. They would say, okay, I need it now, and therefore I immediately specify the buy price. For example, buy price. What is the minimum buy price to be specified in order to get your USD now?
The minimum ask.
At the minimum ask. You're absolutely right. So you, for example, specify 75.01. And such a buyer is indeed an aggressor. Why it is an aggressor? The aggressor crosses or aggresses the bid-ask spread. Instead of placing the order here, they aggress the bid-ask spread and place the order here. In fact, such an order is not even placed because it is an order to buy, and the system immediately recognizes that this order has a price at least equal to the minimum price of the opposite side of the ask, then this order is immediately filled. So what happens? Suppose that this aggressor would like to buy USD at the limit price they specified 75.01, and they specify quantity, how much they would like to buy in lot. So you remember the lot is, minimum lot is 1000, so they specify quantity, for example, equal to 6. So they want 6,000 USD. What happens? So they place such an aggressive order. This aggressive order immediately starts matching with the orders placed at 75.01. So first, they want 6, okay? First, there is a particular sequence here from left to right, 1, 3, and 5 thousand USDs at the price 75.01. Actually, this sequence, for example, 135, corresponds to the time when those orders were placed. So first, someone placed an order for 1,075 for 1, then came another one at the same price for 3, then another one, for example, for 5. So they're arranged first by price, but within each particular price level, the orders are arranged according to the arrival time. And then an aggressor comes with a quantity of 6. So what happens with them?
1 and 3 and 2 of the 5 would be sold to him.
And 2 of the 5, you're absolutely right. So in this case, the asks are transformed uh, in such a way that 1 and 3 are matched or filled, or you can even say eaten up by this aggressive order. So you receive, and then after matching has happened, we say that the orders generated really trades. So now we have trades, these are not orders, but really trades or matches at this price, 7501, for the quantities 1, 3, and there is after that this order for 6 is almost completely filled already. The unfilled quantity is only 2, and then what is the next trade? The next trade is for 2, and this order is completely matched. So it generated 3 trades for the quantities 1, 3, and 2. Okay, so at the ask side, we would then have the remaining single order for 3, which is left out of 5, okay, at the price 7501, and then the next price level, this 2010 and so on, 7502, they are unchanged, okay, they are unchanged. In this particular situation, we had an example of someone placing a completely new order to buy at the price 7501. In this case, this order will not even show in the order book. It is not placed in the order book. It is immediately aggressing the bid-ask spread, and it starts matching the opposite side of the order book. Uh, Similarly, if someone, for example, wants to sell USD but to sell immediately, what would they do? They would probably place an aggressive order at the price, limit price, for example, 74.99, and they cross the bid-ask spread in the opposite direction and start matching with the bids in a very similar way. There is a terminology. If you place an aggressive order to buy, it is called a lift, and you can probably understand why, because in this case you cross the bid-ask spread upwards. If you place an aggressive order to sell, this is called a hit, because you cross the bid-ask spread top down. Lifts and hits. But from the order book structure, you can see that if, for example, you specify the limit buy price at 7501, there is a limited quantity of how much you can get at that price. Yes, you filled your order for 6, right? But the maximum you can get is the sum of quantities at this price level, and this sum of quantities is only 9, right? So you can get 9,000 USD at the price 7501, no more. That's pretty obvious, right?
Yes.
So if you want to buy instantaneously more, you have to specify a higher price. So for example, if you need 20,000, then you specify price 7502 and it starts as a limit price. And it starts matching all orders from the lowest ask price upwards. So now, for example, you want to buy, you specify buy price, limit price, buy price limit at 7502 and quantity equals to, let's say 20 for the sake of the argument. Sorry. It doesn't mean that you jump to the level 7502 immediately. No, this is only limit price. And you start matching all orders from the best ask upwards. So the trades which you generate in this case would be the following: 1, 3, 5 at 7501. So you already filled 9 out of 20 in this case. And then the remaining part of your quantity, which is 11, is matched at the price 7502. This is a very important thing. So you never bypass the lower orders when you specify a limit price. Matching always starts from the top of the book. So those best prices are called top of the book and continues into the depth of the book. For this reason, if, for example, you're a trader and for whatever reason, for example, you made a mistake and you specify a too high buy price. So, for example, forget about this 1% technical limit. Suppose that there is no limit check. You, instead of specifying 7501, you specified, for example, 8501 in your order for 20. What will happen to you? Suppose that you made a mistake, you specified 8501. Okay, in reality, it would be rejected because of 1% technical reason. You are not allowed to place an order more distant from the top of the book than 1%, but forget about it. Suppose that it doesn't work. You specified 8501. Does it really mean that you buy your USDs? Let's say the quantity is 10 USDs. Does it mean that you pay far too much for your USDs in this case?
No,
No. What will happen to you?
you will buy at the best ask price.
First, you buy at the best ask price. You specified quantity 10, of which 9 in this picture, 9 are filled 1, 3, and 5 at the best ask price, and only 1 is then taken from the next price level, 7502. All right?
Yeah.
So that's absolutely normal. This is important to remember. I remember my first trade, which I myself placed many years ago, making a similar mistake, specifying a too high price, because I didn't understand at that point, at that time, how it exactly works. I was terrified that, I was paying far too much, but in fact, it is not. You are matching asks at the best task, then at the next price level, and so on. And most likely with liquid markets, you will fill your order at very reasonable prices, and the price you specify, the limit price, will never even be reached. There are situations in which, of course, such mistakes can lead to dangerous consequences. This would be, when do you think, okay, looking at this diagram, when would it be really a disaster to specify a too high buy price?
If you wanted to buy a big quantity,
Yes. So if, let's say, the quantity you want to buy is relatively high compared to the quantities present in the order book, right? Either you specified a very large quantity, or on the other hand, it is possible that very thin, small quantities are present in the order book. Uh, it is in FX, like for example in the Moscow exchange, you have seen from data, it is completely normal that the average order sizes, we say 1, 3, 5, 10, 20 here, but in reality, they are about from 100 to 100,000 to $1 million. Uh, but if, for example, by mistake you specified 1 billion, which may happen, I have seen such an order. Fortunately, I didn't place it, but I have seen it at some point. Then if you specify 1 billion, then you probably, what do you think, altogether, if we sum up the quantities, all available quantities, for example, on the bid side and task side at each particular time. So for example, there is a time t now. So altogether, how much would we have on the bid side and task side of the order book? This is, by the way, one of the exercises you can do in with your data once you construct the order book. So typically, what do you think the total liquidity, the total size, the sum of the sizes is called liquidity. The total liquidity in the bid side or ask side of the order book, how much would it be?
100 million.
Much more. I think, well, 100 million maybe at some points, especially in the evening time, but I think you may expect 1 billion altogether, hopefully, something like that, which is sizable, but not extremely large. In the past, by the way, Moscow exchange was more liquid than it is nowadays. Uh, Even maybe 7 years ago, the trading volumes and also total liquidity volumes or sizes, they could be up to 10 times higher than they are now. So the trading volume in the Moscow exchange is somewhat declining, in particular due to, unfortunately, uh, not very positive economic situation, international sanctions, and all things like that. It used to be more liquid than it is now. And in that case, it was quite normal to see that someone, possibly a central bank, would instantaneously at one moment execute an order for $1 billion. This would, for example, if you buy $1 billion with one huge order, then you would match or fill or eat up many ask levels. If you do it currently, then it is quite possible that yes, you would remove completely the whole ask side. And by the way, this 1% rule that you are not allowed to place orders very deep, for example, inside bid or ask side of the order book, it would help even in that case. So even if for some reason by mistake you specify the size of 1 billion, and 1 billion is obviously 1 million lots because the lot is 1k. then you would still not get a price for buying worse than 1% of your best price. So the only price difference you would get is 1% because there are no orders beyond 1%. As you can see, this 1% rule is first of all protecting the order book from technical overload when lots of small and extremely unlikely to execute orders would be placed in the rear of the order book. And at the same time, if a huge aggressive order happens, it would also protect the owner of this aggressive order from getting trades at very, very, very suboptimal prices. So this restriction is for a reason, as you can see. And the reason protects both actually the exchange from overloading and aggressors from getting a very, very, very unfortunate price. The worst you can get is 1% away from the top price. Okay, so this is a good thing. Now, let us see some other scenarios. Uh, First of all, there is an aggressive order, a special order type, which is called market order. Maybe you have seen this term. What is a market order?
Someone who specify a quantity without a price, so he
Yeah,
gets whatever is there.
market order, you're absolutely right. Means fixed quantity, of course. Quantity is always fixed. Unlimited price. And still, as we said, this unlimited price cannot be, due to this 1% restriction, your trade price cannot be more suboptimal than 1% away from the top price. In general, using market orders, if you, for example, at some point you build a trading system for yourself, using market orders is not recommended. It is not a thing you should probably do. Why not? Because in this case, you have no control over the worst price you can get executed at. So it may really be that either your size is too large or the order book is too thin, and then you get suboptimal trade prices, maybe close to those 1% limit, and you probably don't like that. So market orders, they do happen, but they are not recommended. Nevertheless, in your data, you may probably, okay, the orders which are not placed in the order book at all might not be in your log anyway, so I'm not sure if you can see market orders or not in the data, but if for whatever reason you see an order without the limit price, then it is a market order.
Yes, it's in the data.
Okay, so it happens. Okay, so you see that in this case, in your data, there are orders which do not come into the order book. Not all orders come into the order book. The order which is aggressive, in particular market order, um, and immediately starts executing, it is not even placed in the order book. So we can say by, it is a very, very, very simple classification. Uh, an order can be a limit one or a market one. Limit means uh, there is a limit price. market without limit price, and a limit order depending on the limit price specified can be passive, which is placed into the order book, and aggressive. Aggressive, not placed into the order book. So order book is always consistent in the sense that the lowest ask is greater than the highest bid. So aggressive orders are never placed into the order book. They start executing immediately. They generate trades immediately. Market orders are immediately aggressive orders. Okay, they're immediately aggressive. Okay. Also, there are some other order attributes. In particular, there is an important attribute which is called time and force. We discussed this one little bit in the previous lecture. So typically, if nothing else is specified, it is day. So the order which was placed and not filled within a day, it is cancelled by the end of the day. It is also possible that time and force is so-called good till cancel, in which case it can even be longer than day, so it is staying in the order book until it is explicitly cancelled or obviously filled, and at the beginning of the next day it is automatically recreated and installed under a new order ID. Or there is an explicit, you can specify with explicit expiration time, which can be in the next day. There are also interesting time and force, which is called IOC, immediate or cancel. This you can probably see, and I think it is quite often used. So suppose that, returning to our diagram, suppose that someone is placing an order, again, an aggressive order, look here, please look here. Now we specify that buy price is, again, 7501 only, and the quantity you specify is 10. Can you tell me, please, so what happens in this case? Buy price is 7501, but you want 10. There is no 10 at this price. Only 9 lots, $9,000 are available at this price.
And maybe 9 would be satisfied and it would be placed as a bid for 1?
Yes, you are absolutely right. So what happens in this case is that 9 are satisfied or filled, and then the remaining one is placed into the order book. So then the order book is transformed into the following structure. So there are asks which now start at 7502 because all those at 7501 are already filled. But bids would have a very peculiar structure. There is a bid immediately adjacent to ask, there is a bid for 1 at 7501. That's unfilled part, all right? Then there is an empty space, which was the former bid-ask spread, which is now empty. And this is important to understand. When you build an order book, some price levels may be unoccupied. So to have something at 7501 here, then empty space, and then the remaining at 74.99 old bids here is completely normal. This is completely okay. But if your order is immediate or cancel, it is a so-called IOC, then the unfilled part of this order, this 75, this one, would not be placed into bids and would be cancelled automatically. So you immediately fill whatever you can, and the unfilled part is automatically cancelled. There might be reasons to do that. In particular, market orders are by default immediate or cancel. What does it mean? If you do a market order for a huge quantity, which matches the complete ask side, and that is possible in general, so you match the complete ask side, then suppose that there is still unfilled quantity in the market order. What happens with this unfilled quantity? The question is academic, so it is a major disaster if it happens, because it would be a major market move, I would say, and it is extremely unlikely and strange to get something in real markets, but the remainder of this market order is then automatically cancelled. So market orders are by default IOCs, immediate or cancel. The unfilled part is immediately cancelled. This is an overview. There are other order types with other time and force. They are not very much important for us at the moment. Why I mentioned IOC is that you may see from the data that, for example, suddenly an unfilled part of the order is automatically cancelled. Does it mean anything? It may be that the owner has explicitly cancelled the unfilled part, but that would happen probably at a slightly later time. There would be a time separation. You still need some time to do it. But if it happened at the same, right at the same time as your matches, this means that it was an IOC, and the unfilled part of the order is cancelled automatically. Okay. Any questions about this? So we have covered the foundations of our trading mechanics. How is your order book building, which you already do in your lab sessions? How is it working? Any problems with that? Have you achieved successful order book construction?
Like I had the problem that I sent you yesterday about the conflicting
Yes.
order book.
Having looked at that, if we have a separate log for trades, we can check the data again, that log. But what I have seen from your example, yes, it is probably an example of simply wrong data. What is wrong in this case? Probably the original quantity is wrong. So yes, your order
Maybe.
yes gives rise to a string of trades with the total at this limit price, with the total quantity of those limit prices exceeding the original order size. How could it be? It can't.
Like this is one thing, like, and it's also in the trade book. But other than this, I wanted to ask a question. Like, from what I understand, that if we want to make the order book at the end of the day, all we just need is to reverse the canceling order at the end of the day, right? Like this could also work.
Maybe, because there are some peculiar order types and strange behaviors, then maybe what you say would work, but yes, because at the end of the day, all of them are cancelled anyway, even those which are with time and force good till cancelled, they're still cancelled at the end of the day. Only they automatically reinserted at the beginning of the next day. So technically, in this particular case, I think you are right. It would still require some kind of verification. So what if we really honestly construct the order book in forward time at the beginning of the day, carry out all those matches and modifications to the order book, and then arrive at the end of the day and compare it with your backward reconstruction through deletes at the end of the day, whether we would get the same. By the way, interesting exercise.
Okay, I will try it because I already tried to do the inverse and I got like order books, but not for today currencies, for tomorrow's only. So maybe all today's were satisfied or they are not cancelled. I don't know.
Well, it depends what is the end of the day. If you consider orders for today, then today's are cancelled not at 2350. Uh, today instruments are traded your USD, your ruble today is traded until 1530, and USD ruble today until 1730. And then for today, there are also special regimes at the end of the trading day, special regimes with which are not that much relevant, but which slightly change the rules of the auction as we have discussed, in order to allow for some manual orders to be executed and so on. I don't remember the details of that. So what happens at the end of this time, 1530 and 1730, is very difficult to describe formally. We need to get the exchange rules and see exactly what kind of peculiar transformations occur at that time. So for today, reconstructing the order book at the end of the day is a difficult exercise, which is affected by many technical factors. If you consider tomorrow's orders, which are automatically cancelled at 2350 plus epsilon, then I think you are right, and the reverse order of cancellations would be producing the snapshot of the order book at that time. But what
Okay,
happens with
thank you.
today's?
I will try to verify it and see.
Okay. So apart from that, no problems with order book construction, I presume. Everything is fine, right? And yes, expect that data inconsistencies in our order flow, they may occur. That is completely normal, and this happens. As I previously mentioned, the main reason for inconsistencies could be a stale order which was not deleted from either bid side or ask side, and then eventually at some point it is still present in the order book. Eventually the opposite side evolves in such a way that you get a bid-ask collision. So tell me please, from the data you have already examined and when you construct the order book, how often do you have these bid-ask collisions? You should always check that the bid side and ask side are not intersecting. So how frequently
I only ran it on one file and This was one that I found, but maybe by next lecture I will have all of them.
So you processed one file and you said you didn't find it at all?
I processed one file, and this is the first thing that I found, the only inconsistent thing that I found.
But let's say if one file, I don't know, consists of 1 million lines, different orders, how many BDAS collisions you encountered?
Like the first file has 6.6 million, and
Okay.
I encountered one.
Just one?
From my code. Yeah.
Okay.
I'm not sure if there is more. I didn't finish the code, but there might be more.
Okay, that's completely normal. So if you encounter irregularities like the total order size not matching, or very infrequently from time to time you encounter BDAS collisions, this is completely normal because the data can be faulty, and that's precisely why we are doing this basically this course. In particular, we are cleaning up our data by transforming the data into the order book format, constructing the order books, and at the same time, that's the part of our data mining. We detect and fix those collisions. I have seen in other FX data sets, not from the Moscow Exchange, but for example, coming from international exchanges such as Hotspot FX, I could even see BDAS collisions coming much more frequently, maybe in 1% of cases. For a file with 1 million lines, you would get about 10,000 collisions. And that is about an upper limit of what you can really tolerate. A high frequency probably means that something is wrong with your book construction algorithm, that you do not understand some subtle details, or it means that the data are so much dirty and poor that you would question actually whether you can work with those data or not. And from next point on, once we are done with what is the general situation actually, everyone is already done with order book construction, or someone is still working on that?
I think everyone is done.
Okay. The next thing, what we do, we get therefore sequences of order books. And the next task, we have already, if we achieved the order book construction, then we performed our task of data cleanup in the same course. So an order book which is consistent is considered to be a correct sequence of events. As you can see, by the way, outputting order book snapshots, if for example you would like to memorize them, would require quite a lot of disk space because the order books are updated in general very frequently. What is the typical temporal separation between two order book updates? What do you think in the examples you have seen?
It's like a microsecond.
Not a microsecond, no. We have timestamps up to a microsecond, that's true. So timestamps are accurate up to a microsecond. In general, if you count the number of order book update events per day, then the typical separation between the events is about a millisecond. So about 1,000 times per second, you get a certain update into the order book. Most importantly, of course, the traders would be interested in best bid, best ask updates, which are also called L1 type events. I will finish this lecture with a bit of terminology. L1 event is best bid or best task, price or quantity change. Okay, that's L1. So if something has changed here or here, a quantity changed, or let alone a complete price level has been, for example, eliminated by matching, and then the price moves, then it is an L1 event. L2 event is any change outside of, in the depth of the book, of best bid, best ask. Change at in-depth levels. There is also a so-called L3 event. L3 refers to the composition of the level. So for example, here the best ask is 135. So the total quantity is 9, made up of 3 orders. In general, it is not that much important, but not extremely important, that it is really 1 plus 3 plus 5. If there is a single order for 9 at 7541, then the cumulative quantities would be exactly the same, right? So a modification is modification of a composition is an L3 event, which may tell you something, but it is less important than the change of price and total quantity, something like that. Okay.
Okay.
So I think I will not delay you for later today. We'll continue tomorrow and also discuss what are the next steps you can do with your order book processing, if no more questions.
Okay, thank you.
Thank you. Thanks. Thank you.